Good afternoon, everyone. My name is Don Eford. I teach personal finance at Hopewell High School in Huntersville, North Carolina. And I decided to do this video so that I could communicate with my kids during this special time and also let someone have information about the types of credit, generally our primary three types of credit, and maybe a little bit about business credit would be our fourth. So the types of credit we're going to talk about today are closed-end credit, open-end credit, and alternative credit. Primarily, most people are associated with closed-end credit because most everyone has a car loan or a mortgage. And that's how we generally see our first credit experience as a car loan. So I wanted to talk about the process of going to get a car loan. And we're going to use a new car today. So again, we're going to go buy a new car, and we're saying that that car is a $25,000 car. You could go to the car company itself and get a loan. You have to have a down payment. You need to know what the interest rate is going to be. And are there any special conditions with the car? Say that I have to bring the car back in. A car company can make you have to bring the car back into them to get service as a condition of them giving you credit. We're going to assume today that there are no conditions, that all I'm doing is buying a $25,000 car. I'm putting $5,000 down, and I'm going to get a $20,000 loan over 6 months. We can talk about terms of loans. I guess in my father's day, an average car loan was 24 months, and then it moved to 36 and 48 and 60. Now they're going out as much as 6 and 7 years in car loans. I cannot advise you to take a car loan out that long, but if that's how you have to do it to get in the car that you need to get you back and forth to work or back and forth to school, then you have to do what's in your best interest, not what's in my best interest. But again, just understand if you take a car loan out for 84 months, you're paying an awful lot of interest, and that car is depreciating really, really fast. So you're probably going to points in time, a longer period of time, going to owe more on the car than the car is worth. When you go for a car loan, whoever lends you the money is going to secure the car as part of the collateral, which means that if you don't make the loan, then they can seize the collateral and then resell that. And if there's a deficiency, you could still owe money to the lender even though you don't have the car. Because like I said, if you get an 84-month loan, you could owe more on the car after making 24 payments than the car is worth, and you would be liable for that difference. So let's say today that we're not going to worry about the bad side, we're going to worry about the happy side. We went to the car company, we found the car we wanted. It's $25,000. I have $5,000 put down. All I need from my bank, credit union, or car company is $20,000. I've decided that I can afford a payment over a 5-year period or 60 payments, and that payment would be around $372. So again, I've got my loan for $372 a month. The interest rate, using that example, is 4.5. It may be higher or lower, so please don't get upset with me if you can get a 3% loan right now for your car. But again, we use 4.5% because I know that's in line with a lot of banks and institutions. So you've gotten the loan, $372 a month, over a period of 60 months. When you make your 60th payment, you're done. You've paid it off. You don't owe the car company, the credit union, or the bank any more money. The car's your title's on it. Their name may still be on it, but once it's paid, it's marked paid in full. You've got the documentation. It's your car. You can drive it for the next 5-10 years, or you could turn around the next day and sell it. It's your car. You're free to do what you want to with it at that point in time. You've met your obligation. The credit is now closed. Closed-end credit on your credit bureau report helps you because, again, it showed a track record of paying for 5 years, and you ended it. It's now at 0, and that's a positive on your credit report. The other common type of closed-end credit that people get would be a mortgage. And the simple difference between a mortgage and a car loan is a mortgage, because the asset is more expensive, is a longer term, generally 15 or 30 years. What I'm dealing with today, I'm going to use the example that you found a house for $160,000. You and the seller agreed on $160,000. You put down $10,000, which is roughly a 6% down payment. Most mortgage companies would take a 6% down payment. 10 is better. 20 is great, because the difference for most people that don't understand is 20% avoids PMI, private mortgage insurance, which is an insurance policy to the bank, but I'm not going to get into that right now. We're assuming you're getting a loan for 30 years, again at the 4% rate, and that you're going to make a payment of $716 a month. The agreement between you and the lender is that you make a payment of $716 a month, generally between the first day of the month and the 10th day of the month. Again, a little more restrictive on the mortgage than the car company is going to be, but the mortgage company wants that payment within the first 5 days, and sometimes they go out the first 10 days each month. They're basing their decision to make you a loan saying, hey, you can pay this the first of the month. It's your mortgage, get it out of the way. Car comes second, credit card comes third. If you have other debt and obligations, you pay them first. Mortgage becomes the first thing you have to pay each month. So you pay them that $716, everything's fine. The negative to the mortgage loan is you've secured your house where you live, where your family's there, everything that you've secured your house, condo. In some cases, even a boat can have a mortgage if you have a houseboat. You've secured that property to the loan. If you don't pay it, then they now have the right to come and take you to court and seize that asset back and do what they call an eviction or forced eviction and put you out. But again, we're staying on the happy side. We'll cover the legal process at another time during the loan process. But right now we're in a happy time. You're making your payments, you're paying your light bill, you're paying your insurance. All those are happy times. Everybody's happy. We're making our payment. We get to keep our house and we get to keep our property. Same as with the car loan. When I make the last payment, so 30 years is 360 payments. When I make the 360th payment, it's my house. I own it, except for the taxes now, kids. Taxes. Again, I own the house. It's mine. I can paint it pink. I can paint it whatever color I want. I have no restrictions at the bank. If I don't want to repair it, although, because when I had my mortgage, the bank expects me to maintain my house, keep it painted, keep the yard clean, to keep it presentable to others. They expect that on the outside to look healthy and happy. But when I own it, I can let my grass grow as long as my neighborhood association lets me get by with that. And I can paint my house pink or purple or whatever color I want because, again, I don't worry about the house's value at that point in time because I've paid for it. Now, smart borrowers and smart financial people are going to keep their house up because it helps the neighborhood's values, helps my house value, and helps my my overall net worth. It's my best interest to make sure I maintain everything and keep it looking good. So we covered that on the installment, primarily a car loan, a mortgage loan, and the third thing that people get is a lot of people get an installment loan where it may hold for a piece of equipment like a tractor or a lawnmower or something, again, that's a fixed time, or just a land loan or a real estate loan involves land. They don't really call it a mortgage, they call it an installment loan on land. Those are the primary things you're using installments for. There are also installment loans called personal loans, to where you just have an unsecured 12-month, 24-month loan for a set amount of money. It's something that the bank wouldn't normally want the collateral anyway. Say that you were going to invest in an alpaca farm. Okay, well, they don't want any alpacas, so again, you may need $10,000 to buy your alpacas and put your fence up, but they don't want the alpacas, so they would probably make you just an unsecured loan for a period of time to buy your alpacas. Again, those are the types of closed-end credits. So when we go to open-end credits, that generally deals with a credit card. Credit card can be either a Visa, a MasterCard, or a store card, but generally those are the two. I don't believe about American Express or Discover, but they're at the primary people when they think of a credit card, they think of a MasterCard or a Visa. The name on the card doesn't really matter. It's a process of being able to take the card, give it to a seller processes it, you get the stuff. You now owe the bank, the credit union, or the store for the items you purchased with the credit card. The difference between a credit card and an ATM card or a debit card is the credit card is a line of credit, and say it's a $5,000 credit card. If I buy $200 worth of clothing and pay it back by the end of the month or by the end of the period, I don't owe them any interest. I've used their money during that period. Now I'm back to zero. I've got a $5,000 credit limit again. The difference between a debit card and the credit card is the debit card's coming out of my checking account. The $200 will come directly out. Now my checking account balance has gone down. I'm not getting any use of that $200 that's already gone. It's been invested in the clothing or used for the clothing. I shouldn't use investment, but it's been used for the clothing. Now I own the clothing. I get to wear it, do whatever I want to with it. So the credit card can be, again, from a bank, a credit union, or a store itself, and they issue the card, you use it. There are much more flexibility in the cards because all the store cards now are either a Visa or a MasterCard, because that allows that person to use the card in other stores. I guess because I'm older than dinosaurs, I do remember when store cards could only be used at the store. Because if you had a Belk's credit card, it could only be used at Belk's. If you had a Dick's credit card, it could only be used at Dick's. Now they issue them as a Visa or MasterCard with their name on it. Now their Dick's card can be used at Academy Sports. I always like that one because you lay down you're at Academy Sports, you lay down your Dick's credit card, and I'm sure in the olden days when we just after we killed the dinosaurs, that would offend the store person. So I guess you were doing it. I don't know why. Maybe you were offending the store guy, but hey, that's another story for another time. So again, you can use your Dick's credit card at Academy. You can use your Dick's credit card at Chili's. You can use your Dick's credit card at whatever place you want to because it's tied to Visa or MasterCard, and it's an open-end line of credit. They don't restrict where you use it. And again, if your store credit card is restricted, let's say a Belk card does not have a Visa logo, then you can only use your Belk card at Belk's. Therefore, it doesn't help you at JCPenney's or Forever 21 or wherever you go. It's their card, only can be used at Belk's. Again, but it's still an open-end credit, so if you go to Belk's and you have a $2,000 credit card and you buy $500 worth of Belk's goods, at the end of the month, if you pay off the $500, it resets itself to a $2,000 credit card again. So those are the primary uses of those. Now, again, there are a couple areas of open-end credit that not everyone uses. People will get a line of credit or ready reserve on their checking account at some institutions, and it's basically tied to the checking account that says if I go over by $100, you loan me $100 short term, I pay it back. I don't get charged an NSF fee. Smart move because, again, anyone can make a mistake in their checking account, and if you make a mistake, they don't hit you for that. And that's called a ready reserve account or check reserve account, and a lot of people use that. It's open-ended. It's generally not a lot of money, $1,000 to $5,000. You can have them as high as $10,000 or $20,000, but I don't know why you'd want that. But again, I don't deal in those numbers, so if you deal in those type of checks, hey, happy for you. The other type of credit would be a secured line of credit, most commonly an equity line where you have a mortgage and there's equity in your house. Using my example, you bought the $160,000 house, you've paid it down to $100,000, you have $60,000 worth of equity. The bank may allow you a $30,000 equity line so that you can use that. In a lot of cases, people use that for tax purposes to buy the car because it becomes mortgage interest as opposed to car interest, and that's another way to handle credit and use credit wisely. Use your equity line to buy the car, take the tax deduction if it helps. If not, don't do it that way. Just buy the car loan, do the installment roll on. So we covered the primary things that people are going to have. We have an installment loan for a car, a mortgage or a land loan. We've got our credit cards that are Visa, MasterCard related. We've got our store cards. We've got our ready reserve, and we've got our equity line on the house. That probably covers 95, 98% of what people are going to do in the credit side. The alternative side is an area to where alternative credit is that. It's just not from a bank. It's not from a credit union. It's not from a car company. It's a different form of credit. It could be a loan from your mom and dad. It could be a loan from a friend. Most of the time, alternative credit is associated with a pawn shop to where you take in a good. I use the example in class of a $500 TV. You take it in, they loan you $50 or $100, and you have to pay that back in 30, 60, or 90 days. When you pay that back, you get your collateral back, which is the TV. In the case of the pawn shop is saying, hey, we want you to come back and pay it because we're getting a fee of, say, $25 plus the interest during that time frame. It's a good loan for them because they're charging you 18% of the money. It's short in nature, so there are a lot of benefits to that person. And here's the other bad news. Most banks won't make you a $100 loan. Most credit unions won't make you a $100 loan. And again, sometimes your parents won't make you a $100 loan. So again, it's a source for you to use if you need $100 or a small amount of money for a short period of time. Another type of alternative credit would be a payday loan. I think in North Carolina, they can only call them check cashing loans, to where you give them a blank check for $100. They hold your check until Friday when you get paid, or the end of the month when you get paid, and then you pay them back $100 plus a fee plus the interest. An expensive way to borrow $100, but if you have to do it, that's another way to do it. But again, please read the contract, understand what the fees are, and understand when the rollover period is to where they roll that $100 over again and you now owe them for another month. That's the key with those type of loans, and make sure you pay them off, get out of them as quick as you can. Refund anticipation loan is another issue. That happens more from like January, February, March, is when people are filing their taxes and they're going to get a refund. The credit card company says, not the credit card, but the tax preparer says, hey, you're going to get back $1,000. We've got a refund anticipation loan to where we'll give you the money now and wait for the IRS to send us the money back. In most cases, say you're getting $1,000 and they're going to give you $850, charge a fee, and then charge interest on it. Again, an expensive way to borrow the money, but you get the $850 today as opposed to waiting 30, 60, 90, 6 months for the money to come back in. But that's another type. Title loans are not in North Carolina, but that's when you take your car, and they are available in South Carolina. So you take your car into a location, your title into a location, that location loans you $100, $200, $300, $500, $1,000 on the title itself. They don't hold the car, they just hold the title. We don't do that in North Carolina. Another issue is rent. Another way to borrow money is called rent to own. You see that a lot with televisions and furniture and small appliances, to where the seller of the product is allowing you to take the product home and pay them back over a period of time. If you don't pay it, they come get the property back, the oven, the TV, whatever, they come and get that back. And I guess the under rent to own, I have seen some situations where people buy property under rent to own, and under rent to own, they've agreed with the seller. Say the seller thinks the property's worth $100,000, but you don't have the 10% down or the 5% down to go to the regular bank. The seller wants to sell it. They say, well, hey, I'll rent to own the property for 2 or 3 years and hold back $25 out of each payment. That way you're building up some equity with that seller. You're not really building it with a bank. It's not going into the credit union, but it is a way to get into the property, own the property. You can do with the property what you want under that contract, but it's a contract between the seller and the buyer. I could probably do a whole hour on rent-to-own contracts and what to watch out for. But again, it is a contract between the seller of the property and the buyer of property. You get to treat the property as your own. You could, as I said in that case, paint it pink, paint it purple, whatever. It's yours. At the end of 3 years, you have to give that seller the full amount of the money they were asking for. Using the example of the $100,000, you've lost the equity of paying. You only got the $25 that he held back for you. So that's what you've reduced his $100,000 loan for, is by those 36 payments of $25. So again, that pretty much covers what I wanted to get into. There's some other issues we'll deal with, is amortization schedules, and some other types of credit issues and savings for this section. But again, I wanted to get this information out to you in a different format. If you have any questions, this may create more questions, but I'll try to do another one on some other areas and dig deeper into some other subject. But again, thank you for watching. If you like it, click like. If you didn't like it, click dislike. Again, thank you for watching the video, and we appreciate your time.